The biggest risk to markets right now is the consensus view that the Strait of Hormuz reopens in relatively short order, that oil gets exported from the Gulf, and that the storage and refinery capacity limitations dissipate, which drives a retrace in the price of oil and inflation expectations. In our opinion, that is what is priced into risk assets today. I think there are a lot of risks to that view. There's still a very real chance that the conflict escalates with ground troops or some sort of accident with the current blockade. One thing I've been saying to our traders more recently is that it's important to remember that the S&P is not a good indicator of global economic health right now. While we will all have to deal with price pressures from oil and gas, the European and Asian economies are facing the very real possibility of actual supply shortages, and that is likely yet to be truly felt. That is going to put European and Asian central banks in a really tough spot. If a repricing of risky assets is the biggest risk, I'd probably say any material retrace in yields remains the best opportunity. In the near term, that is our area of focus, at least until we get to the second half of the year and start watching developments on USMCA renegotiations and the US midterms. Well, first off, although we obviously saw material swings in mark-to-markets and by extension the sources and uses of collateral over the last 5-6 weeks, we didn't see any stress in funding markets like we did during Liberation Day or the gilt crisis of a couple years ago. I think that's partly due to the fact that risk assets behaved well, with most of the stress coming from the rate and vol markets due to changing central bank expectations. A lot of the market activity in March was from the hedge fund community, and they run with tighter stops and unwind risk, so there was less of that medium-term collateral need. We saw very little pressure on asset swaps or the bond basis, which is typically indicative of funding stress that we saw during Liberation Day or COVID. And on the listed side, the CCPs are much quicker to increase margin floors, but gradually over a couple weeks, which creates a larger buffer for clients and their FCMs. Looking forward, with the advent of distributed ledger technology and collateral and settlements, I only expect the efficiency of collateral movement to improve and the ability of dealers and primes to move more varied types of collateral around the globe to solve problems for clients and the market at large.